All right. So this presentation is on sort of hidden items in insurance policies. And the best way to explain it is the industry has what are called sublimits. So what is a sublimit? Inside of insurance policies, there are often clauses that limit how much an insurance carrier will pay. So on a really simple one, for instance, if you bought a life insurance policy, you buy the policy for $1 million because you want to protect your family. And somewhere in there it says, hey, we're only going to give you 10% of this death benefit if you died from cancer. And so if you don't read the insurance policy, you wouldn't know that that sublimit existed. And the same thing applies in property and casualty insurance, in personal lines, home, auto, umbrella insurance. Before I jump into that, I want to talk a little bit about the industry really quickly. California is in a very complex market right now. Nationally, insurance carriers have been losing money. California is off to a bad start in 2025 with the LA fires. They had the North Carolina hurricanes. 2024 had barely 1%, profitability. 22 and 23 were loss years for carriers. This makes a big difference because when carriers have years where they're losing money, it affects their stock prices, it affects how they have to react in the market, it affects the pricing that they're going to pass on to consumers. And so there's this very complex set of things that are going on in California. You have legislation where the California is trying to control pricing and how insurance carriers react. Prop 103, you'll hear a lot about that in the news, where insurance carriers can't just raise rates, but it also means that if they can't get enough rate, they start leaving. You may have heard like State Farm was canceling policies and may leave California. That's related to this. There's laws that were passed in 2018 that enhance how carriers pay out in declaration of emergency, and the carriers haven't been allowed to raise their rates to offset that risk. And all these people that are fighting over the laws have their lanes. You've got the Department of Insurance, and there's been a lot of incompetence at that level, and there's been a lot of rhetoric and blame. And you've got consumer groups like Consumer Watchdog, who seems like they would be like a consumer watchdog that actually wrote Proposition 103 that allows them to challenge insurance carriers who want to raise their rates, and then they get paid for that by the insurance carriers that pass that on to the consumer. There's a lot of self-dealing going on in some of the lanes. I drew a picture of it right here. This scribble is kind of what the California insurance market looks like right now, because it really is chaos. And we're dealing with all these losses in California. There's fire and there's crime and there's water. Water, people don't hear about it as much, but water is a big factor, like roofs that are older and aging plumbing. San Francisco has a lot of water concerns where you have homes with galvanized pipe. And so the carrier responses have been to exit the market and to lower their policy coverage forms, meaning they offer less coverage. So a lot of the stuff I'm going to talk about today on policy limits, some of the carriers have stopped offering full coverage on these things now because of all of this. And they're entering the market back at a higher cost. They exit and then come back in. So I want you to know this and know that you have to be very careful filing claims. Know that if you file a claim with your homeowners or your auto insurance and it's at fault, or you've got like a water claim in your house, you don't want to call your insurance carrier first. You want to find out what that loss is likely to be. Call a plumber, because people are finding that the era of being able to file small claims with insurance carriers is over, and they get caught in it. State Farm is canceling a lot of policies in Northern California right now. So we're getting calls from people shopping for insurance, and in a lot of cases we could help them, except for they had a water loss, and a lot of carriers won't write. So I urge everyone to caution on use of their insurance and how you use it and whether to call an insurance carrier until you know what your loss is going to be. I have a 2-hour class that I'm teaching on this subject, but I threw this in here so you know that the stakes are high in California. It seems only fair. And so when we get into the sublimits, the process of shopping for insurance everywhere is this bombardment of advertising, and you get no meaningful metrics. I put a picture of the Progressive group on this slide because they don't advertise what their coverage is. They advertise their connectivity with one another. Like if you're on this call and you watch TV, you can probably tell me something about Flo and about Jamie. Like these people have these stories. This is the single most effective advertising campaign in the history of advertising campaigns. Progressive has just hit it out of the park, but they don't really talk about insurance. And so when people are going to switch and save, or they're in good hands, it doesn't mean anything. But if you call me and say, hey, I want to save money on my insurance, I can actually sell you an insurance policy that has less coverage than you had and not tell you that you might not be able to rebuild your home, or that I'm taking something away. I'm saving you money. There's no fiduciary obligation for insurance brokers in the state of California. So without useful information, people will just pick a coverage limit and they'll move on. The problem is there's this continuum of insurance contracts. Down at one end here, you've got this dollar sign, and you have these very limited form policies. They might not cover any sewer backup, or there's no extended replacement cost. I'll talk about what these are in a few minutes. And then up here, you've got these more expensive policies that are, if you have a loss, the carrier shows up with a check. And in the middle, you have these carriers that are building their policies based on a statistical model, meaning that 90% of their insurance policies, or if you have a claim, are going to fall within having a $5,000 sewer backup, or maybe you don't need a lot of extended replacement costs because your house isn't going to burn down. 9 out of 10 people are going to have claims inside of this statistical model. And the problem with that is that, whoops, this thing just doesn't work with that. Is that when you have this bell curve here, if you have a claim and you fall outside of the average claim, all of a sudden you start finding out what the carrier doesn't cover. Oh, we're really sorry, but we don't do, building ordinance or law, or, you just don't have enough coverage for this. And that's where people really need to make financial decisions. So there's no right or wrong to this. Someone can look at a middle market carrier and understand that they're taking on some risk by paying less money. There's no secret in the insurance business. The more money you pay to an insurance carrier, the more they're probably going to owe you if there's a loss. And the less you pay, the more risk you retain, generally speaking. So there's nothing wrong with retaining risk. The problem is a lot of people don't understand that they're retaining risk. And so they find themselves out on one of these outlier claims without really understanding that could possibly happen. And that's where a lot of the complaints come from in the insurance business and in the country, but particularly in California. So we have these methods of calculation. This is a part of a spreadsheet that we use to analyze insurance at my office. So when someone comes to us and talks about insurance, the first thing we want to know is, what do they have? And this has this isn't a complete spreadsheet that we use, but it will give you sort of the moving parts that we're going to cover in this presentation to talk about. So we like to know who the home is titled to. Some of you may have seen in the news that a couple of carriers in the LA fires had had said that they weren't going to pay a claim because a home was titled to a trust, but the trust wasn't an additional insured. And so they weren't going to pay a claim. And so we always make sure that if there's a trust, it's added as a additional insured. And the premium on this is obvious. This is what they were paying, and this is what the person ended up paying. The home form is very important. They had a homeowner form, HO, because they owned the house and they lived in it as their primary residence. They had earthquake insurance and they didn't have flood because it wasn't a flood zone. I'm not really going to talk about earthquake today, but when I get into like policy deductible, they had $1,000 policy deductible on this home. That's very low in California. If you file a couple $1,000 claims, you're going to lose your insurance. So we like to see people with higher deductibles. So we bump this up to $10,000. So we don't, if someone's really going to file a claim on this house, it's going to be a real claim. And we track the dwelling year of construction, which was 1998, because I like to know how we're going to rebuild that house if it burns down. But when we get into some of the parts where you pick the coverages, right? Like replacement cost here is $677,000 on a 3,800 square foot house. So when you get up to 3,800 square feet, you're usually talking about people putting in higher end appliances and granite and some hardwood floors and things like that. So they had this house insured for $176 a foot. We got some pictures of the interior and we did an analysis of the homes in the area. And at the time, we figured out that this house should be insured for $400 a foot. So our cost, our replacement cost on this house was 1.5 million, and they were insured for 677,000. They were underinsured by more than they were insured for. Their total uninsured was $862,400. So if they had a loss that fell into the statistical model where it's a small electrical fire in the kitchen or something, this policy probably would have been okay. But if they had a large catastrophic loss, this policy would not have rebuilt that home at $176 a foot. And so then we start talking about, well, what are the settlement options of the insurance carrier? Well, some insurance carriers that operate in this statistical model, they will either rebuild at replacement cost or they will give you actual cash value. So if this client couldn't have rebuilt the house with $677,000, what they're going to do is say, well, then we're not going to give you replacement cost money. We're not going to give you the 677. We're going to depreciate this home back to its original 1998 dollars, and we're going to give you significantly less than that. So they might, you know, on a total loss, if they can't rebuild, they might only get $400,000 or something from the insurance carrier because of depreciation. So we insured the house to value, and then we put a policy in place that would pay them cash if they decided they didn't want to rebuild, which happens a lot. So the replacement cost is important, but the settlement options are also very important. How does a carrier settle its claim? And when you have an underinsured home and you have this actual cash value function hidden in the policy as well, all of a sudden you're in a bad situation for getting money out of the carrier. Even this is extended replacement cost. This is a hedge for the policyholder. If there's a demand surge, for instance, when there's a large catastrophic loss like happened in Los Angeles, you're going to see it more expensive building. So they gave an extra 50% on top of the 677. But even that's only $1,016,000, well below the 1.5 million it would take to normally build a house. We put in a 200% extended replacement cost, so it would take them to $3 million if they needed to rebuild the house. So one policy is set up for statistical loss, and one policy is set up for catastrophic loss. And notice though, they're not huge difference in premium, but we did increase the deductibles to $10,000. So really the choice is, you know, how do you want to be insured on this? This person probably would have been okay if everything worked out the way It usually does where people don't have a claim. But in a true claim, they would have needed a more robust policy. So really the question is that people should be asking themselves when they're buying insurance is, what is the result that I want if there is a claim? Am I willing to take risk and take less money? Or do I want to make sure that I'm insured to value and I can rebuild my home, or at least take the money and do something else with it? So these are questions that people need to be able to answer, but don't know how to answer because the industry doesn't teach them to ask the questions.
Brian, can I interrupt you for a
Yes,
second? There's a
yes,
question in the Q&A.
yeah.
It's clarifying about the trust question. Did you
Mhm.
mean to say that the homeowner's insurance must be in the living trust if the residence is titled as a living trust? Or did you mean that the homeowner's insurance must entitle as
I'll
living
answer.
trust?
I understand the question,
Okay.
so I'll answer it exactly as it should be done.
Okay.
If you have a trust and you title your home to the trust should be named as an additional insured. The trust should not be the named insured. The named insured should be your name and your spouse's name or whoever owns the house with you, because a homeowner's policy has premises liability and it has regular liability. So if you were out playing pickleball, for instance, and got upset and threw a racket and hit somebody, which I know no one would do, but somebody did before because there was a lawsuit on it. Um, your homeowner's insurance would respond to that. But if the trust is the named insured, it won't, because the trust wasn't playing pickleball. So you want to name the owner and trustee of the trust as the named insured and the trust as an additional insured. And you want to name the trust versus the trustee because you want the trust to have a coverage grant for any successor trustee if you happen to die. So there's a very specific order of operations there that a lot of people miss, but that's the true way to do it.
Thank you. And there was also a question, how do you calculate the replacement cost coverage?
I'm going to talk about that in detail on a couple slides as we go forward.
Okay. Thank you.
So this slide I developed. It's about sublimits, and if you add sublimits, like when you add how the settlement option works, which is a sublimit if it's actual cash value, when you add building ordinance or law sublimit of 10%, what this does is says that we're only going to give you 10% of that $677,000. So your actual limitation here is $67,000. So if you're going to rebuild and you have to redo a foundation or put in, charging stations for electric vehicles, you have to rewire the house to the current Title 24 codes, they're only going to let you use $67,000 of that money. So again, you have a sub limit inside of that actual cash value sub limit on the other screen. So these things begin to add up and make it impossible to rebuild a house in a catastrophic loss. And therefore, that's where I came up with this statistical model, because this is designed to protect the carrier in catastrophic loss and protect the client in small losses, which is a valid approach because these policies generally cost a lot less than full policies. But you still need to understand that the way this is built. Couple other quick things on this. They only had $135,000 for other structures, but this particular client had a pool house in the backyard, and we valued that at $308,000. So it was only like $300 a foot for the pool house. Wasn't very fancy. But if you've got some other structures, you want to make sure your gazebos and your hot tubs and all that kind of stuff are covered to value on the policy, because this 135,000 that the carrier offered was just a function of a percent of coverage A, which is the replacement cost. So pay attention to what's in your yard. And I'm going to tell you, if you have a fence blow over in a windstorm, that's not a claim I would file, because old fences blowing down are as old as the hills, but that's a very it's a small claim. And then if you have a large claim and you have two claims inside of 5 years, your carrier will probably cancel you. So, you want to make sure that if something happens, you really do want to file that claim because it's financially necessary to do. Sewer and water backup, these are often sublimits and often excluded. So the number one cause of loss in my insurance agency, if you add up all of the property claims I've ever had since I started this agency, sewer and water backup is the top. That is water coming out of a drain. And the reason for that is that it's very expensive to remediate, because anything that comes out of a drain is either black water or gray water, which means it's a hazmat issue potentially. So you can't just dry it out with a fan. You have to remove porous materials, and you have to have a environmental hygienist come in. There's a whole series of things that need to be done. So something that might cost $5,000 with water that came from a pipe under your sink might be $150,000 if it came from a drain and got underneath your flooring. So it's very expensive to remediate these. And these are often either excluded or they're limited to like 5,000. So knowing what you have is very important. And I've heard every reason why someone thinks that they're invulnerable against sewer backup. And for every one of those reasons, I have a story of a claim that we've had because we've been doing this a really long time. Water will go wherever wherever pressure pushes it. So it will go uphill, it will go up 3 stories, it'll do whatever it needs to do to get where it wants to be, which is in an area of lower pressure. So we've seen a lot of this. Loss of use is important. So if you have a loss on your home, where do you stay while your home is being rebuilt? And this particular policy had a 12-month limit on the current policy. So if they had a loss and they didn't get a permit, say inside of 6 months, and a contractor was 3 months out on work, they could easily run out of loss of use and have to pay their mortgage and a place to live. So finding out how much loss of use you have is very important. This one was expressed in a monetary limit, and it had no time limit. This one has monetary with a time limit. So asking yourself if there's a time limit is very important when you're talking with an agent. And these are questions that you can ask agents, and if they can't answer them, move on to an agent who can, because there's really good people out there in the market, and there's really bad people out there in the market. So find the good ones. Use this presentation to get some terminology, to ask the questions of someone. And one real big question is, if I have a claim, will you help me? So if you're interviewing an agent who wants to be your insurance agent, ask them how much they help people who have a claim, because I guarantee you, when you're having a rough day because your house has a problem, you're not going to want to be talking to an insurance adjuster. You're going to want to have someone translating that language for you and helping you. So it's very important, I think, to ask if they're going to help you or not. There's liability discussion here that I'm going to do on another page. So I'm going to skip this and move on because our time is somewhat limited here. But this is how all of these sublimits work together and why I think they're important. And I'm going to elaborate on some of them. But the question about replacement costs. So coming up with a replacement cost can be difficult because, for instance, wood windows are 3 times the cost of a vinyl window, and metal windows are even more expensive. So we had a claim one time in San Francisco where it wasn't my claim. I do pro bono work for the Financial Planning Foundation. So sometimes people with claims will call them, and they'll call us and they'll help. And so the carrier, the house was built in the early 1900s, and it had wood windows, the house. And the client wanted wood windows, but the carrier wanted vinyl windows because they said that was what people use now. And that was true replacement cost because that's what normal homes are using now. And then San Francisco came in and said, no, in the marina, you have to have a metal fire rated window because of after the Loma Prieta earthquake and the fires, they put some code in place. And so the windows went from something like, $20,000 to, $150,000 on the house. And that was all building ordinance or law. So knowing how much your windows are going to cost is a big deal. People will replace, with high-end windows and not think to add any replacement cost to their house. If you have a steep roof, that is more expensive to rebuild. If you've got, stone, you can buy stone from Lowe's or Home Depot, or you can custom import stone. If you've got really expensive carpet or, flooring, if you have the type and the origin of your flooring makes a big difference. If you're importing exotic hardwood, there's a lot of reasons why exotic hardwoods have gotten more and more expensive over the last few years as the United States has imposed environmental embargoes on some countries for the way they cut down rainforests and things. So it's very important to understand what's going in your house. If you have a contractor working for you, it's a really good idea to say, hey, if this house had to be rebuilt from the ground up, including the foundation, what would be the cost per foot? Sometimes it's a good idea to have someone come out. It might be worth the investment of having a contractor or an appraiser say what the home should be valued at. The systems that the carriers use for replacement costs are substandard. The San Francisco Chronicle just had a great article on this. It's all about how carriers are suppressing replacement costs. And one of the reasons is they're trying to be competitive with one another. So if you run a replacement cost estimator in like State Farm or Liberty Mutual or Farmers, they all kind of come out the same because the carriers are trying to sell insurance. And so you have these people. If I use one of those estimators, I can come up with a pretty reasonable cost estimation, but I know a lot about construction. I have a construction background. I'm from a family of contractors, and I grew up building houses for my family business. So I know a lot about how to fill in replacement cost calculations, but most insurance agents don't have that kind of experience. They're salespeople. So you want to spend some time figuring out, what the value of your home is. And, the average house in San Francisco runs about $500 a foot just on a low end, builder's grade type, with tile counters and things like that. If you start out in granite and hardwoods and things like that, it's very expensive. And if you're living in a Victorian and you want that house rebuilt like a Victorian, you need to really shop carriers because they're going to use more common construction methods. All of these things kind of go into the replacement cost considerations. It's very difficult to just say, in San Francisco, we insure houses for $3,000 a foot, and we insure them for $500 to $600 a foot, depending on, what they've put in them. So
Brian,
I'm going to talk. Yeah, go ahead.
Can I interrupt you again with some questions, or do you want to wait?
No, we can talk. We can stop.
Okay. So someone was asking if you need legal guidance dealing with these issues. Is there a certain type of lawyer that you would recommend, or what kind of legal help do you need?
It depends on the legal need.
Okay.
So there's a couple of really good insurance lawyers in California or in San Francisco. So if a carrier's not performing like they should, there's a couple of really good insurance lawyers. And you know what? I'm totally drawing a blank because I'm not there in my head. But I could easily give out the names of a few of those in an email to you, and you can disseminate it or whatever. If you're talking about real estate law or estate planning law, it depends on the problem, right? If it's construction defect, right? Someone worked on your house, that's a construction defect attorney is different than an insurance attorney. So But I will say this, San Francisco is lucky in that it's a really nice place to live, and a lot of professionals like to live there. So from an attorney standpoint, there's a lot of really great people to pick from different disciplines. So some other markets don't have that type of of depth. So
Okay.
if you be more specific about the type of loss, I can tell you what kind of attorney, because we work on with a lot of them, because there's always something going on in my world.
Okay.
So,
Um, someone was asking, how else can you assess the ethics competence of an agent?
well, you can ask how long they've been in business. You can ask if they help with claims. So a lot of the stupid things on auto forward, sorry about that. You can ask them how they help with claims and if they have any experience in it. Um, those are uh, those are really good indicators, because a lot of insurance agencies, like, so we do business with Safeco Liberty Mutual, and they have a deal where I could pay them 5% of our commission base, and they will act as a service agency for us. So I don't have to, when you call for service, you're not calling my agency, you're calling Safeco. Well, I don't do that because I'm never sure who you're going to get when you answer the phone. So agents who use exterior service entities, either the insurance carriers or they outsource it, they're suspect, because that means that they're sales oriented versus experience oriented. So if that makes any sense, right? Like we want we want our clients to have an experience that's because most of our clients come from financial advisors, so we're part of a process that they're doing, and there's a lot of agents like that, but you have to find them and interview them. um, I've somewhere I've got a list of questions that we came up with, me and a financial advisor whose house burned down, and we were doing some pro bono work, and I bet I could find that list of questions. But those are good indicators. If they're not going to help you in a claim and they outsource their service models, I would be careful. And you can ask them how much experience they have in replacement costs too, because right, if you're in this all the time, um, you ought to be able to take some pictures of a home and know what that cost per foot is going to be. Like, so any really good contractor, if I tell you I'm going to build a house, if you tell me you're going to build a house and I'm a contractor who knows what he's doing, I'll say, tell me about your trim level. And you're like, oh, I'm going to have Sub-Zero fridges and Bosch and this and that. And I want to have, custom stone. He's going to say, that's going to cost you $1,500 a foot, and you know, your appliance allowance is, 80,000. And so tell me what the square footage of your home is going to be. There's no secret to any of this. Contractors know exactly how much everything costs. If you're going to import stone, you're going to put in marble, add 20%. So people who are in the game know all of this. It's the people who are like, how many square footage of molding do you have? Well, we're assuming we're going to have molding in that 1,500 a foot, right? So,
Mm.
so understanding, professionals know what they're doing. And so if you know a few of these questions and it trips them up, run.
I'm going to ask one more clarifying question, and then maybe we'll
Yeah,
save some of these other questions for a little bit later.
sure.
This is about other structures. Is a detached garage considered an other structure?
Yes. Anything that's not connected to the house is another structure. A deck is another structure, technically.
Okay.
So
Um,
it's,
there are some more questions, but you might be covering some of these, so do you want to move on and we can
yeah, let's go
revisit
through
these?
this. I want to talk a little bit about building ordinance or law. So if you're rebuilding, you have to rebuild to a new code. So like in the 1970s, this can add up really fast. In the 1970s, you could wire a house so that your bathrooms and the outdoor outlets were all on the same circuit. So you could have a 3 bathroom house with outdoor circuits all on one circuit. In our new world, you have to wire dedicated 20 amp service to every bathroom, and it can't be shared. So that means that if you have a loss on your house that has to do with fire, you may have to rewire the whole house to add those 20 amp circuits to bathrooms. So these codes are really serious. It causes unpredictable expense for the carrier, and that's why they treat it as a separate cause of loss. So they'll say you had a fire, and that's the first cause of loss. And then they'll say the building ordinance or law is the second cause of loss. And so they'll express this as a percent. So a lot of them will cover 10% or 50% or 100%. The more building ordinance or law you can have, the better, because you never know what your code burden is going to be. In San Francisco, if you have a house that's 50% damaged, the likelihood is they're going to make you tear that whole house down and rebuild. So that's already having to comply with something, and you're tearing down part of a house that the insurance carrier doesn't want to. So these building ordinance or law can be very important, and they call it an extra coverage. And some carriers will say it's an extra coverage, but it's actually excluded and brought back in. So in the insurance business, when we say we're giving you something extra, what we really mean is we're putting a limit on it. And like if I told you you're getting extra ice cream, you'd be like, yeah, I'm getting an extra scoop of ice cream. And that's what I'd mean. But in insurance, I mean, we're putting a limit on this and we're taking something from you. So it's disingenuous, and it's very important to understand. And I missed this one. Homes are often remodeled with grandfather code. So people will tell me, oh, the house is to code because we did this kitchen remodel and they came out and inspected it. That doesn't mean anything, because once the walls are opened up, if the fire department goes through your house, they will open up every wall to make sure there's no fire. And once that happens, the city comes in and says, okay, here's what you have to do to bring this up to code to get it you know, to have a certificate of occupancy. And I have these houses here. Everyone knows these houses in San Francisco, right? And the point of this picture is there's a thing called architectural and historic code. If one of those houses burns down, San Francisco is absolutely going to make them replicate that house. San Francisco makes a lot of money, with filming in this park, and they want those houses intact. If they want to paint one of those houses, you have to go and get a permit from the city, so it's a certain color. The historical code is very important in San Francisco in some neighborhoods, so you have to be very careful that you follow that. And that can be a very expensive build because you have to build a modern home but make it look like one of those houses. So anyway, that's building ordinance or law. And it covers everything: seismic and energy and historic ordinance and residential fire sprinklers. You have a loss big enough one, they're going to make you put in fire sprinklers. So anyway, this thing goes on and on and on. And I can't really explain how important this can be if you have a loss, and why as a sublimit it's so damaging to people's finances. Because if you have $1 million house, right, assume the home is insured to value for $1 million and it's truly $1 million, it's not underinsured. If there's an ordinance and law sublimit of 10%, that's 100,000 that you can use toward code. So if you have a 20% loss, or you have a loss on the house and you're rebuilding it, and 20% of that rebuild is code, that equals $200,000. So you're $100,000 out of pocket to rebuild that house. The house was insured for $1 million, but you only got $900,000 from the carrier and had to pay out of pocket $100,000 because of the way sublimits work. So these can play a large role in whether someone can rebuild that house. And if you go back to my little spreadsheet, you remember that they all kind of work together. So if you don't happen to have the money laying around, or it's 30% or 40%, right? So now you're at $200,000 or $300,000 that you have to come up with. Maybe you can't finance because of loan to value. And so what do? Well, now the carrier can give you actual cash value, and they can take that $1 million and depreciate it down. So these are real scenarios that have happened over the years. So this is why we teach the class on sublimits, because it's so important that people understand it. Right now in the market in California, there's a lot of carriers that are not writing above 10% building ordinance or law because they can't get enough rate from the state of California to offer what we call broad form policies. So there's only a few carriers that are offering really broad form coverage right now. And some of them have limited their appetite in California. So they only let agencies write 1 or 2 policies a month or something, because California is really experiencing an insurance crisis right now. Sewer backup. This thing is very expensive. Like I mentioned, there's emergency cleanup, porous materials have to be removed, enzyme treatments for any remaining materials. So anything that's not porous has to be treated specifically for sewer backup and removal of hazmat materials. You got to have an environmental hygienist clear the house, because if you sell that house and you had a sewer backup in it and someone gets sick and the new owner, they may come back and sue you. So we have liability issues. So all of these things are really play a role in how you insure your home. You want as much of this as you can buy from whatever insurance carrier you have. Also, if you've got special limits on personal property, like most policies will only pay like 5,000 for furs, 5,000 for watches. So if you have fine arts or collectibles, you really need to add them to the policy. They're not covered under your regular contents coverage. So you need to know that if you happen to be a watch collector, and your house burns down, they're only going to give you $5,000 off of a normal homeowner's policy unless you've itemized the jewelry. A lot of people don't know this. They think it's a part of the content. So we like to make sure they understand it. And now I'm going to talk about liability a little bit. We're running up on some time here, so I'll go through this pretty fast. Carriers split liability into 2 parts. They have property damage and bodily injury. That's what you'll see on most policies. And those are together, and then they have what's called personal injury. Personal injury is libel, slander, false arrest. It's the things that are soft. And the reason that carriers dropped personal injury out of their policy forms back in, say, 2004 or 2005, we were beginning to see the rise of social media, and people were publishing their opinions much more readily. And so people started suing each other. Well, you said this about me, and you said that about me. And, one of our clients was served an eviction notice on a tenant, and they sued him for invasion of privacy. That's all personal injury. That was $80,000. There was a claim example. This was back in, I think this happened in 2012. Some young women, this is when kids still used Facebook. Young women at a school published some allegations on Facebook about a teacher at their school, and he was fired. And so they ended up settling. The school settled with him for $363,000. The parents had to pay that, and now it went into a punitive phase. That was never disclosed what the final. There was a non-disclosure agreement on what the final was, but this is from a private school, and the parents ended up paying a lot of money because of libel, slander. It ruined his career. The allegations were of a sexual nature. It was at a school. He was innocent, but once that allegation is made against a teacher, their career is essentially over. And so this is all personal injury. And most insurance policies that we review do not cover personal injury. You have to add it back in by endorsement. So 80% of State Farm policies that we look at, 80% of Farmers policies, those are the 2 largest carriers in California. So 80% of the people on this call have one of those 2 carriers. Chances are personal injury is not on your policy. If you go to your policy's declarations page, you can see whether it's there. It'll say personal injury or personal offense on the declarations page under the endorsements. It'll have a list of endorsements. There'll be California disclosure, there'll be all kinds of things. And if it doesn't say personal injury, call your agent and have them at it, because this is real. If someone files a suit against you for something one of your children does, or some perceived slight, or whatever, or mental anguish because they have post-traumatic stress disorder from falling down your stairs, you want to have this coverage. That's why the carriers took it out, and that's why we want to put it back in. So this is a very expensive claim and a very inexpensive fix. They're like $20-$30 for the endorsement on any carrier I've ever seen. The other thing to think about is umbrella insurance. For most of our clients, most other people pose the greater risk, right? So it's other drivers, it's contractors working on your property. Umbrella insurance is very inexpensive relative to what happens. If you have umbrella insurance, you have a homeowner policy with $500 or $1 million of liability, and then you have an umbrella policy. The idea is that you're basically forcing the carrier to defend its own money instead of your money. And carriers always are going to look at what's the cheapest way out of something and try to settle. So, if you have $1 million net worth and a $2 million umbrella, you'll probably be okay. The carrier is going to defend you. So, a lot of things happen with, someone might stop in front of you, or a kid might run out in front of you on a bicycle while you're driving your car, or if you have a birthday party at your house and a kid is injured. Every single one of our claims that have gone into the umbrella, they're strange. They're not like some egregious behavior that someone's doing. They're not like drinking beer and shooting road signs. I mean, that's by the way, a sport where I come from. They had a birthday party and someone got hurt, something really unexpected. So umbrella, very important to think about, and look for personal injury sublimits in umbrella. If there's a sublimit there, change carriers, because you don't want to have a sublimit on personal injury either. A lot of them are doing that now. And then the last thing is uninsured motorist. There's a lot of people driving in California that have no insurance or very little insurance. So having an uninsured motorist is really important. Oh, this is still talking about umbrella, but I want to talk about uninsured motorists. If a third party driver injures a family member, your health insurance carrier, the hospital will notify the health insurance carrier that you were in an accident, hoping to get, retail rates. And so they won't bill your health insurance. They want to bill an insurance carrier because you come into the hospital. So uninsured motorist is something that if you have a loss, that your health insurance carrier can't put a lien on it. It's highly protected insurance. It's the most important insurance. Personal injury, sewer backup, and uninsured motorists are the three things I worry about the most, because statistically they're the most likely to happen. So I think that takes us through the presentation, and we have some time for questions.
Thank you so much, Brian. We definitely have some questions here. So let's see. I'm just going to start reading these off. How is condominium insurance different? For example, each homeowner owns a portion of a building. So
typically, there's two types of property in a condo: an HOA property and unit owner property, which is usually walls in. So a condo owner owns walls in. So you really don't have a lot of liability for the stairs and the HOA and things like that, unless you're having a party at your house serving alcohol and someone falls down there and the HOA says you're at fault. But you want to insure walls in on your condo for property insurance. You're just not insuring all of it. You're not insuring the exterior. And the liability function on a condo insurance is exactly the same as a homeowner's policy. It goes with you wherever you go. But you want to make sure that you're insured to value on that, because I see very low limits on a lot of condo policies in San Francisco. And if the average house in San Francisco said costs $600 or $550 a foot to insure, figure the average condo interior is going to be $300 a foot, because that's the expensive stuff, the kitchens and the bathrooms. The cheap stuff is the siding and the roof. So
okay. That actually is a good segue. should we claim home insurance for replacing a new roof? Or if the roof was damaged, can we claim home insurance?
If the roof is damaged in a covered cause of loss, a windstorm, a tree branch falling on it, something like that, you can certainly make a claim against your homeowner's insurance. But if you make an insurance claim because it's an aging roof, it's leaking or something, the insurance carrier may come out and say it's wear and tear, and they'll charge you with a loss, which will cause you potentially to lose your insurance at renewal. So you want to be very careful how you file a claim on a roof. If a tree branch, blew onto your roof and penetrated it, and rain was pouring in or something, yeah, you call the insurance carrier because you have to protect your property. But if the roof is aging and it was, or if it comes off in a windstorm or something, yes. But a lot of people will wait until a roof is, end of life, and then it will leak, and they'll say, oh, the roof was damaged, when really the roof is just end of life and it's wear and tear. So you want to be very careful of that.
Okay. This is a good question. How often would you review your insurance policy to make sure the replacement cost slash home value is current enough?
Every couple of years, every 2 years or so. Most policies have an inflation rider of 5 or 8% or something, depending on what their values are. So if you insured a home, say to $1 million to this year, next year it's going to go up by a little bit. So you just want to pay attention to what's going on in the market. For instance, if you're down in the LA area, we're going to see a spike for the next 5 or 6 years on replacement cost. That's part of a demand surge, but it's going to be so large and so long that it's probably going to stay. And the Santa Rosa demand surge never really went away, right? It went up at the end of the 2017 fires, and it never stopped being that expensive again in Santa Rosa. San Francisco is very expensive to build. Like, I know a construction company that allowed $100 per foot on projects because of parking and all the trouble that you have to go through in San Francisco. It's a great city, but it's very difficult to get anything done.
All right. How do you decide how much umbrella insurance you need?
Um, what I use on that is, if you're between $1 million and $5 million of net worth, I'll generally go $5 million. If you're above 5 million, I'll jump to 10 if you can find a carrier that will do it. And above 10, you usually start to talk cost to value, because it's a completely different class of umbrella, right? The pool of people that need over $10 million is significantly smaller than, say, who need 10. And even that's significantly smaller than the people who need 5. The average is, net worth is somewhere, buying umbrellas somewhere between, maybe 1, 2, 3 million, something like that. So $5 million umbrella would probably do it. And I would add, if you're using a carrier that will allow you to do it, I would add as much uninsured motorist in the umbrella as you can buy. The more that you have on that, the better. So if you're injured and your attorney you need a personal injury attorney to negotiate with your insurance carrier about the nature of your accident, the more money you have in the pot for that attorney to be paid, the better. So the liability stacking is kind of more of an art than a science, and there's a lot of risk reward to it too. So
Okay. Let's see. We're almost out of time. Let's see. There are some like more kind of specific situation questions in here, but let's this is a good one. Just I think what they're saying is, what is a fair deal on a $1 million policy? So this is a question about pricing for
an
policy.
umbrella.
They don't specify, but it was asked just a few minutes ago, so maybe that was the.
If it's on property, there's no way to estimate that, because proximity to hazard is, a factor. There's so many factors in property insurance, but on an umbrella policy, for $1 million of liability with $1 million of uninsured motorists, you might be talking like $700-800 a year or something like that,
Okay.
typically, with a house and a couple of cars. See, it all depends on what you've got going on. If you got a bunch of cars, they're going to charge you for the cars, or so. Umbrella insurance is relatively inexpensive. The problem is you have to find a carrier. I like to see all the policies in one carrier. So home, auto, umbrella. So whoever has the umbrella from the first dollar of the loss has to contemplate the entire loss and negotiate in good faith based on that. Because like if State Farm has the auto and Markel has the umbrella, well, State Farm's trying to pay as little as they can on their auto insurance, and Markel's hoping they're never going to see it. But if State Farm has the umbrella and the auto, State Farm's got to act like if they've got a $2 million umbrella over a $500,000 liability policy, that they're going to have to pay $2.5 million. It changes their attitude a little bit.
Indeed.
The insurance is a lot about forcing people. What you're really doing is you're just aligning your interests with someone else. You're paying money and forcing them to care about you as much as you care about you. That's what insurance really is.
Thank you. That's a very useful way to think about this. Well, we're out of time. I know we're leaving some questions unanswered. I apologize to folks if we didn't get to your question. Feel free to contact us, our department, bizscitech@sfpl.org, or give us a call. We'll try our best to direct you to answers for these questions. And yeah, thank you all for joining us today. And thank you so much, Brian, for being with us today. I know I learned a lot, and this is very, very useful information, especially in California these days.
There's 12 questions in here, Jonathan. For the people who didn't get there, there's one about knob and tube wiring. I mean, we don't have enough time to do it, but if they email you at the email address that you gave them, I will answer the question via email.
Okay.
I'm happy to do it, but time is time, right? So, but I see there's 12 or 14 of them now. So if someone asks the question, I'll answer it. I'm happy to do it.
Okay. So, folks, please, if you still have a question, email us, and I will, we'll forward that to Brian and get you an answer there. Keep an eye out for a follow-up email. It will probably be sent out early tomorrow because the video recording won't be processed by the time we leave the library today. So keep an eye out for that follow-up email tomorrow morning. It'll have a copy of the recording, the slideshow, and an evaluation survey. And you can reply to that email if you had an outstanding question. So yeah, thank you, Brian, for offering to answer the unanswered questions. And yeah, thanks again for being here today. We really appreciate it.
Yeah, it's fun. I like doing this. All right.
All
Have
right.
a nice evening, everyone.
All right. Take care, everyone. We'll hope to see you at the next program here. Take care.